Good afternoon, everyone. Morning for some, evening for others all over the world. I want to welcome you to today's live trade call for TPO. Of course, triple play options having to do with all strategies depending on the volatility in SPY, which brings some strategies into play and others out of play. So the photo of the week here is a lightning shot I got a couple of years ago. That is off the beach of Clearwater Beach, actually, and it was just one little storm, and a nice big lightning shot comes out of the side of the storm. So, uh, got a good one on that one. All right, before we get started, just one reminder that you have the ability to own trade partner stock. It isn't here yet, but it is coming very, very soon. And even if you only want to buy $100 worth of stock, you have the ability to own stock in the platform that you trade with and be a part owner of that. And it's really cool. Won't spend a lot of time on that. I did a presentation on that about 2 or 3 weeks ago, and there'll be more information coming out on that in the near future. All right, for those that are new on the call, I want to welcome you. But I also want to warn you that I do not explain everything about these trades on the call. It is impossible for me to do so. They are meant to be cumulative, meaning that you learn the more you attend, the more you learn, and the more you understand. And I also want to warn you that as you learn these trades, they are absolutely fantastic. There are some fantastic trades in here. However, they are not the holy grail. And you need to make sure that you are not reckless in how you put them together. You need to make sure you follow the instructions, and you need to start small. There's plenty of room for compounding on these trades, even on some of the higher margin trades. And there's going to be one that I show you today that is something that will be much more in line, I think, with most of you. If you have about a $10,000 account or so, you can place this on as based on current conditions, pretty much week in and week out, and just add a little bit to your account, which will allow you to also increase your efficiency of compounding with the other strategy as well. So be very, very intentional in how you do this and in how you approach these trades. I know a lot of people come in here and they see some of the trades and they're like, I'm going to do a 50 lot or a 100 lot or a 10 lot or whatever the case is. And I'm telling you, you don't need to. If you make a mistake in that, you're just going to come right back down and start with a one lot anyway. And so you might as well just start that way because the compounding allows you with extensive potential growth in your account. If you can average about $100 a week, we're talking about growing your account by as much as $30,000 in just 6 months by compounding that. Now, don't come in here thinking that you're going to start averaging $100 a week. That's probably not what you're going to do, although I do have traders that come in and do that. Um, but you don't need to. If you only average $20 a week, if that's all you average every week on some of these trade strategies that you can compound more efficiently, you can grow your account over the course of 5 years to as much as $1 million. And if you can average $100 a week, you're talking about 3.4 million. So it is very, very powerful. It's the compounding that grows the account, and you just need to make sure that you are following a strategy that gives you a high probability to make a little bit of money every week. Now, some of the strategies you cannot compound according to this table. It's much slower. For example, option insanity is one of my favorite strategies when it comes to low volatility, which is basically what we have in the markets. We have fairly low volatility, although we saw a little bit of a spike down this morning. That's going to go clearly. It's going to go away pretty quickly as the market already recovered from that spike down, and we'll start to see volatility come back out of the options. But this is an option insanity, and it's basically where we're selling the Monday and buying the Friday. So we sell the Monday, buy the Friday before that. and we'd take advantage of the accelerated time decay off of the short options compared to the decay off the long option, and especially the last couple of days of the trade. But these things have tremendous time decay in general, all by themselves. And so you can push the break-even level way out there. Here's a trade that we're in. It's long February 12th, 382, and then short 5, 392 calls. And of course, we have a margin hedge in place. I believe the margin hedge on this one is at 420, so it's on up there a ways. But this was done at a credit of 285, and you can see it has a nice, large, big profit bubble here. So as long as we don't go to 394, 395, I'm not worried about this trade at all, and it'll most likely offer many opportunities to exit unless we see a spike, at which case that's where the risk on this one comes in. And it is a fairly large risk. It's not one that you're going to be trading a lot, a large trade size on, but it can consistently pull in easily $100 to $150 a week to just enhance the other strategies that you're doing. You can also get crazy with them. So I put this one on. This is the 389 and the 381, where the strike difference is only 6 points away, but it is 5-1, and I did it because I wanted a big credit on a particular trade. And not only that, but it has about a $400 per week time decay rate. So I like that, and at $400 a week, you can't complain as long as the market doesn't spike again to around 392, 393 would be where the break-even level is. But this is a February 5th, February 8th, so this is actually in less than 2 weeks. This expires in less than 2 weeks, and so we're going to see, as long as the market doesn't spike, we're going to see this thing start to really provide a profit. And by the way, I put it on Thursday, I believe Thursday morning, and Friday it already had a $150 profit. And right now, I think we're standing at around pretty close to that. The 389s, I'm making $115, $120. Yeah, it's about $150 profit right now as well. And again, volatility kind of increased the time value in that option. So you can go all over the place. I have a guy who does this, and he just goes for like a 40 or 50 cent credit, and he goes way out of the money. So he does a 5-1, does a 40, 50 cent credit, goes way out of the money to where the break-even level is, like 20 points away. So you can do that with a smaller credit and create those super high probability scenarios. One of the things that I advise everybody to do is to watch the trades until the end. And so one of the trades that we placed on 12/29 and got out basically 1 week later, which was 122, 125, 5-1 option insanity. So exactly what I showed you, only 376, 386 were the strikes. And again, I get into these for about $150 profit target is what I'm shooting for fairly quickly. And that happened within 1 week. I got out. And that one, as of Thursday, this was Thursday's shot. Well, here's Friday. You can see here, if I would have held on, I did not. Okay, I was not in this on Friday. I actually saw it trade at about $750 profit at one point. So that's this profit bubble, right? That's this profit bubble here. If you're right in the middle of the profit zone or the profit zone and the profit bubble, if you will, those things can provide some pretty big winning trades if they close at that point, right? And then here's the 2-1 option insanity trade that I had, and I actually had on several of these. Here's what that one looks like, a 2-1. It was from an 80 cent credit. And at the time that I placed it on, the market was trading at like 368. So it had to go way up there. And it did, like really fast. This is also one that I put in late December, right? So I put it way out there. But market has to go way higher from where I got in, and it did. All right, we saw it trade at 385 at one point. However, I had already gotten out of this particular one. An $80 profit is not bad because it's basically the credit. Depends on where you're at and when the profit is available. That's kind of how I determine where I'm going to exit these. If I'm getting close to the edge and there's a lot of time and I've got a profit, I'm going to take it because I can always push another one out there, right? But on this one, I took a $130 profit on this one, and it was trading as much as $153 as of the close on Friday. And of course, the profit peak is right at 380, and the market was trading at like 382, 384. So there's actually about a $250 profit potential on this one, a little bit more if the market would have traded down at around 380. So I got the majority of the profit on that one. All right, so it's this one that I want to focus on for just a second, because I know one of the problems that some of the traders have, and there's nothing wrong with this, and there's nothing wrong with saying, you know what, that's just too much risk for what I'm doing, for my trade size, for whatever. Because if the market really wanted to skyrocket, there is some risk on this one, like $4,000 to $5,000. Worst case scenario, the market, would have to be unprecedented move to the upside when it's already, basically trading at all-time highs. So it's not going to happen, but you still have to prepare for it and make sure that you can still trade. You don't want anything to wipe your account out, period, end of story. If you're in a trade that can wipe your account out, you're trading, you don't need to be in that trade. There's just too many other things that won't wipe your account out. All right, this is a great trade, but you can't do it on a small account. Of course, it requires a lot of margin. But if I could get rid of this risk, if I could substantially drop this risk down to like almost nothing, like $30, $50, and it's in a really small area, then this might be something that that you guys might be interested in. Well, here is what is available, and this is basically a 2-1. Only you're hedging it. I'll call it a 1-2-1. So it's a sandwich type option in Insanity, and this is where it's at. It's a long 380, long 390, and then the shorts are right in the middle, sandwiched at 385 are the strikes. And this is a 212, 212, 216, and this was put on for zero credit, zero. So there's no credit, no debit. And because of how this is structured, ultimately, if the market tanks, there's no risk, and if the market skyrockets, there's no risk. And in reality, the only risk is really at the long strikes, and it is super small based on current volatility levels. Now, that could increase just a little bit if volatility jumps up and the market's trading right there at 380. If volatility jumps up and the market's trading right there at 380 or right there at 390, but that is super small. And you see these profit bubbles that basically give you a substantial area between 380 and 390. That's where you should make a little bit of money. Obviously, with a bigger profit bubble at around 200. So this still requires margin, because you'll have to do a margin hedge, which means that there'll actually be a little bit of a debit here. But this is something that if you have a $10,000 account on, you don't have to worry about the risk on this. It absolutely has no chance of wiping your account out. And you're not going to lose anything if the market tanks. You're not going to lose anything if the market absolutely skyrockets. The only places are those little small risks. So this is something that if you've got extra margin in your account, you were worried about option insanity with regard to the risk on these types of trades where they're basically open-ended, then you can hedge. You'll get rid of the credit, but you can hedge that way. and you can add, who knows, maybe $50, $75, $100 a week. Some weeks the market will go the other direction or way higher, potentially, and you won't be able to add anything. But because of this particular structure, it is a solid. Obviously, I can't say risk-free, but it is as close to risk-free as you're going to get in something like that. Again, what causes these little bitty small risks at the long strike? It's however much value is on the 385 calls. In either case, there's not going to be a lot of value in the 385 calls, okay? Because it's going to be 5 points either in the money or out of the money. So there's not going to be a lot of time value. Whatever time value is in those, though, that's what your loss could be. So at 380, is the 385 going to be worth $5, $2, $1? Is there going to be $100 of extrinsic value in both of those? That'd be a $200 loss. No, not in the current situation. Not in current. Now, if the market tanks and volatility skyrockets, you need to be sure to stay tuned to these calls, and I'll show you how that will work out or not work out, as it may be. All right, so I'm going to spend just a few minutes on this, not a whole lot of time, so that you can. We're going to kind of explore it just a little bit, because this is something, again, that I put together because I know some of you have said, hey, I like Option Insanity, but there's too much risk. And I just want to show you that there's all sorts of different ways to put on an Option Insanity trade. I'm going to show you one other one different here in a second. And I know I said I was going to spend more time on the crazy calendars, and I am, but Option Insanity is here for now, and we really, I really want you to be able to take advantage of it if you can. So here we're going to take a look at this is the 121 based on 2/5 expiration, so less than 2 weeks away. And I want you to notice that there are some that you can pull a credit on. Right, here's a 370, 375, 380. And of course, the shorts are at 375. So where's your profit zone on this one? It's between 370 and 380, depending on the volatility. Now, this is the one where you have to be careful of, because if the market does move down, there will be higher volatility. So you're not going to see quite the profit bubble that you would think, or that you see when you're talking about profit zone where the market is at or above, but it's at a credit. And so you've got a little bit of room there to work with. And you'll see here that the 371, 376, 381, so that's just one strike higher each, credit of 30. The next one is credit of 27 and 22. And the key is 0. If you can get 0, that's your least amount of risk. That's your highest probability, 0 or a credit, right? So 374, 379, look at this one. We're trading where we at right now. We're at 383.10. So we're right almost at the 384 level, but this is trading at a credit. So here's the 375, 380, 385. So we're trading again in between 380 and 385, and it's at a credit. And you can go all the way to 377, 382, 387, and you basically got a debit of 3 cents. So that'll cost you about 3 cents, plus the margin hedge, which will require 2, right? And the profit zone, the middle of the profit zone is at 382, and we're trading at 383, 383.40-ish. Last I looked, right? So yeah, 383.07 right now. So we are like right in the middle of the profit zone. So in 2 weeks, less than 2 weeks, if the market doesn't do anything, if we're still hovering around here, we're talking about that, okay? That kind of profit potential right where we're at. So close to maybe $150, $200 if we don't go anywhere. If we tank, obviously the risk, max risk if stocks absolutely tank is $3. The risk at 377 is probably going to be a little bit more than what we saw on this. And so I'm going to bring in this one. I'm going to show you this one. Okay, this is a 216, 212, 212, 121 with a 380 is the short strike. So 375, 385 are the longs, right? This is actually at a credit of 10 cents. And you'll notice that I've got the volatility a little bit higher here because if the market moves down to 380, then there might be a little bit more value in that 380 long, or excuse me, 380 short. So that is projecting a profit of $752 right at 380, and that would be 376 each, and we're short from 530. So basically what this is doing is it's projecting that the value of the 380 shorts are going to be at $1.54. And that's probably pretty accurate. So $1.54, if it's much higher, let's just zoom this in. I mean, let's really crank this up a little bit to unrealistic numbers. So if for whatever reason we're sitting here at 385, which this is not going to happen in all likelihood, if we're sitting at 385, then we might lose $50. More likely is if the market moves down, then we might see this type of scenario where there's a lot more value in those 380 calls, even though they're 5 points out of the money, and you might lose $50 on this trade type of thing. Right. So that's kind of gives you the gambit of range on how those work. All right. So you get much further in there, and you can see here that there are debits. 380, 385, 390 is now at a debit. I actually got into this trade right here, 252825, at a zero cost basis, and it's now trading at a 26-cent debit. Okay, so it does have some time value. You see here, we go 385, 390, 395. It's trading at a 49-cent debit. So if the market goes below this, obviously they can still retain some profit in there. Okay. All right. So then let's take a look at the next week, just to kind of get an idea for the time value on here. That's not the one I wanted. There it is. All right. So this is 212, 216, 212. And you'll see here that you can go the first credit. Whoops, I was already way up there. Sorry. Let's see or I should say last credit. So here's the 377, 382, 387. And it is at a credit of 17 cents. I'm going to take a look at 377. 377, 382, and 387. 1 week later is trading at a debit of 3 cents. So there's about maybe $20 of extrinsic value, time value on the first week of this trade. If you want to see what the current one is at, we can go 129, 21, and 129. And that one's trading right now at looks to be about a 38 cent debit, right? So Yeah, not going to be huge. This is going to increase this week significantly, especially if the market starts trading at around 382, which is getting close to where we're at right now. So by the end of this week, this could go up to, a debit of 175, 185, 200, somewhere around there, if the market stays the same. Okay. So it is best to hold on to these if there's a chance that we're going to be in the profit zone during expiration. Okay. All right. So that is that one. Something that almost everybody, will have the ability to do. All right, let's switch gears and move to crazy calendars. Here's one that I put on again, February 5th, February 8th. This is a little bit different in that I went 390 calendars, but I only did 3 of them. I opted for a credit instead of going with more calendars because just didn't see us continuing to move to the upside at the rate that we've been doing. And I purposefully slanted this a little bit more to the bearish side of things. And so this one right now, I had it open earlier and then I lost it. So let me pull this up. And maybe I might pull it up here. So 2, 5, just to track these as they go. It's so important to know how time and price action affects these trades so that you aren't freaking out if you get into a trade and it starts showing an open position loss when you have no reason to freak out type deal. I've seen it happen so many times where traders get out of a trade at a loss and they had absolutely no reason whatsoever for doing that. But this is a trade that I did specifically because you could put it on with one order. If you go more than the 3 calendars, then the Trade-REC even did this. If you go more than 3 calendars, then you're in a situation where they're not going to place the order because they only allow 3 lots on one of the legs of a spread anymore. Used to be better. Used to be where they actually would still place those trades. As a matter of fact, I was able to put 5-1 trades on a single order, and now you can't put a 5-1 trade on with a single order. You have to leg into it, which is fine. It's not that big of a deal, especially with Trade Partner. Makes it super simple. All right, so what I used to pay for those calendars was a 388, 392 diagonal spread, and this entire trade right now is trading. Let's see here. It says at a credit of 8, so I'm making a little bit of money on this one. As you can see here, it's a credit of 8. And this one, again, the maximum gain to the downside is going to be 37 cents. So as long as I'm well below this 388, 392 area, or the calendars especially, I'm not concerned about this trade. Obviously, if the market skyrocketed, I'll be losing money, but yeah, I would hold on because you have to accept the risk of whatever trade that you have on. Is that, and the risk on this trade, the max risk on this particular trade is $363. Okay, and I mean the market would have to absolutely skyrocket for that to happen. It would be, I'd be shocked if one of these trades, if you put them on consistently, if you had a couple of weeks in a row where you lost $100. It's because once the market moves up like this, you've got a situation where you can go even higher and decrease the probability of that loss occurring. All right, so that brings us to the question, okay, well, what about any trades right now? And where are we at? So we're at 380, 383-ish, just trading a little bit above 383. So we've completely made back the drop that occurred this morning fairly quickly. And let's just let's do a spread pattern, matter of fact, and do the same thing. Where we are going to look for these trades. We're going to go one more week out to begin with, and then we'll see what's available. So we'll go 12, 16, or 12, 212 and 216 is what we'll take a look at, and we'll go. Let's do 390s. Well, it doesn't matter what we do because we're going to look at all of them. All right, so we'll go 390, 390. Those are the calendars, and then we'll go 388. So we'll do exactly what we're in, 392. All right, so that. And we're going to do 3 calendars. All right, so we go one further week out, and it's trading at a credit of 20 cents, which is not bad. Credit is good on these. The calendars themselves, kind of expensive, actually. And I think they're kind of expensive because of what happened today. I don't think they were this expensive. They're trading at like 35 cents, 36 cents a piece. So we, theoretically, you go further out and probably be just fine. But nonetheless, we're going to start with 3. We'll start with 380s. We'll go all the way up to 400s. 400 on the calendars. And generate spreads. All right, so the one thing on this is that this particular expiration may or may not have all of the strikes, so we may see some that aren't. All right, so here is 380, and 380s are the calendars with 378, 382 is the credit, or the diagonal spread, I should say, at a credit. You can see this, if it's in the money, trading at $1.22. And basically what that means is that your max risk on this is $275. All right, but you're trading at a spot where you might actually realize a little bit of a loss here. And so it's kind of like right in between. Right, this is why I don't do in the money. Yeah, you can get a bigger credit, but we are on, this is where this one's at. It's trading somewhere around here, right? And the overall EMR, equal movement ratio, is positive, because if it moves down, we're going to go into this big profit peak, which is a bigger profit than the max loss, and it's going to have to move up pretty significantly for us to realize that max loss on that trade. All right, so there's nothing wrong with these as far as probability is concerned. You just can't expect to make, you're going to suffer losing trades more often by going with the in the money ones, where the market has to move down to reach the calendar spreads, even though you can get a better credit from those. All right, so let's see how far we can go and still get a credit on this. So it looks like about 392 for the calendars, with a credit of 390, 394, and we can still bring in a credit of 8. That's not a whole lot, but at 392-ish, gives you quite a bit of room for the market to move up. At 392-ish, you're going to make you're going to be able to make $150, maybe even a little bit more if you hold on to it. Again, these are not tremendous as far as the credits are concerned. So you're only make $7 if the market tanks, and from that point on, it's a debit. And you do not, under any circumstances, with this type of trade, want to put on a debit, because the probability of success is, or the probability of the market moving up enough for you to realize the profit is just not, it's not conducive. You don't want to just give away, $5 here, $10 there, et cetera, et cetera. Even though you can go way out of the money on this one, again, it's one of those things where you want to be intentional about what you do, and you want to make sure that you put yourself in a position to where you're not losing money. Is little probability of losing money as possible, while also achieving your goals of whatever it is with your trade. So that's with a $400 risk. How do you make this? How do you make this a bigger credit? How do you make this more bearish to neutral, without increasing your overall risk by a whole bunch? And the answer is by simply going one more strike on the diagonal spread. So you have a 5-point diagonal spread instead of a 4-point diagonal spread. Now that increases your risk because you're increasing the strike distance, right? But you went from a 5-cent credit to a 32-cent credit, and these are 392 calls. So the profit peak here is at 392. And anywhere between here and about 395, you're going to be making money. All right. So very high probability of success on this. And if the market tanks, $30 a week, even if that's every time you did this, you only made the $30, that actually compounds fairly quickly. And you have a very high probability of being able to pull out more than $30 on any move to the upside with this trade. And so when the market's trading like this, I prefer taking a little bit more risk to the upside on something like this. But you can do this on any of them, right? You can go all the way. So here's a debit of 4. And if I want to go, well, I can't do it on this one because the strikes goes from 396 to 398, but still, that puts the profit peak at 394, and I have a 31-cent credit here. This one's a bigger risk because you have 6 points difference, right? So that actually puts your risk at $570 on this trade. But again, look where the break-even point is going to be around the long leg, maybe a little bit less. Well, maybe a little bit less than the long leg, and especially on the ones where we are a little bit further away, right? So if we go to 395, this is a 3-point difference, and you're pulling in a $27 debit. Well, that your risk on this is $327, right? And you're risking $27 to the downside. So I much prefer doing something like that. Only I wouldn't do it with a 398. Let's go a little bit further and see if we can't. So here's a 10-cent debit, and I'm going to go with a 399 if it's available. Nope, no 399 there either. So if I go $400, the calendars are at 396. I have a 15-cent credit. Okay, this is going to require the market to just absolutely skyrocket. Not going to make much, but you have a high probability of success on this particular trade. Very high probability of success. Okay, so you can be much higher probabilities, or you can and lower risk, or you can choose to go with a bigger credit. Okay, so here's the 390. This is the exact trade we have on the previous week from a credit of 37. And if I go, well, I can't go 390. I can go only 392 on this one. 393. Oh, sorry, 394. That's what it was. So if I go 6 points on that one, all of a sudden now I have an 82-cent credit. Okay, my risk is 520, but I have an 82-cent credit, and my profit peak is going to be at around 390. And so, you know, if I want to make it more bearish, that's what I do. That's how you do it. Let's see if I can't pull this up on a graph. So 1 second. So I just while for those of you who are on PDS Trader, so I'm on PDS Trader. We've got an issue with the SPY data, and as a matter of fact, my programmer just texted me and said it should be resolved today. He's working on it. He thinks he's found the problem, and that should be resolved today. Nonetheless, in the meantime, I've had to rig this stuff as we go along. I say rig, it's not really rig. Let me see here if I can find one close to what we were talking about. And here we go. So I'm going to move, let's see. Nope, I'm not going to do that. I'm not going to do that. I'm going to wait. I think everybody understands, you know, from this risk graph, exactly what this spread is, right? So do that. All right, so if you make this a 393 call, which you can't do, actually you can. If you make this a 393 call, you create a bigger credit. And that creates a little bit more risk to the downside. So the reasonable risk on this trade would be about $100. The reasonable expectation from this trade would be about $100 loss if the market really moved higher over the next week and a half. Okay. Anything beyond that, it's such a small probability of happening that it's not something that you need to create your entire trading plan on, which is why I say, even though this one has a risk of $363, $364, somewhere around there, that the compounding that you can use on this is still the $100 compounding table. Okay, I have no problem using a $100 compounding table. The $100 delta compounding table on this. If you're not familiar with that delta, what the delta is in a compounding table, I strongly suggest that you go through the fixed ratio course. It's called Mission Million Money Management course. Okay. Nonetheless, what are a couple of variations of this that you can place? These are all, this is all stuff you can place with a single order. So I'm going to go ahead and place one that is with a single order. Let's see here. And I'm going to go place trade. Whoops. I'm going to bring this over. And we're going to do this. And let me see here. We're going to go 212, 28, or excuse me, 212, 216. And I'm going to do I'm going to go ahead and do 390s as the calendar. So I'm going to go 390 and 390. And quite frankly, I'm not a huge fan of doing the calendars when you're paying 35 cents, 34 cents, whatever. Market's moving higher now. Gosh, we're up 81 cents after the tank this morning. But, and the reason I'm not in favor of paying these higher paying a higher price on these calendars is because the volatility is going to drop. If we're trading at 390, we're not going to see these calendars worth near as much as if the market moved down to 377 like it did the other day, a couple of weeks ago, and moved right back down to our calendars, and we were able to take a pretty decent profit on that before it even reached to being at the money. You get up here and you're talking about these calendars maybe at 390, maybe on expiration worth $1.10 type deal. I mean, it's the profit peak is just not going to be as big, right? So I prefer paying less for the calendars. However, you get what you get, and so those are the calendars. Oops, I already did that. And how am I going to pay for it? A couple of different ways. For one order, I'm going to go 388 and 393. Nope, 394. So I'm taking a bigger risk on this one. And we'll go 3 calendars. Taking a bigger risk on this one, but I have an 83-cent credit. Okay, that will really help out. As you know, if the market doesn't make a big move, it'll be a much more decent profit. So I'm going to put it at 84. Whoops, 0.84 credit, and then I'll go ahead and place that thing. And we will see if that gets filled. Let's see here. All right, it is now working. Where did it go? Oh, there it is. All right, so it's showing it's a large bid ask spread. It's a $1 bid, 70-cent ask. So we're trading like right in the middle of that, and that's where the order is at. The only issue with this type of one single order trade is that you are not going to get the best price. You're going to get better price by legging into this stuff, and that's because you got 4 legs working, and all 4 of those legs have to meet um, to create the single price, and it's just harder to get filled on those. So I could probably go ahead and get filled on this if I were to leg into it. I'm not going to do that for today's call, but that gives you an idea. This is the trade that I talked about on Thursday that I was in. So this is basically adding to that trade for the following week with a similar structure. Only I have a bigger risk, but I have a bigger credit at 85 cents. So we'll see if it gets filled before we finish. All right. I want to do one other thing, and that is compare the prices of going even further out in time. So let's take a look. We're going to reset those, and we're going to go one more week out. 219, 222, and 219, and 222. And we can't go 392, so hang on one second. So we're going to go, so 222, this is what I don't like about. Every now and again, they get all squirrely with how they do the strikes. So they only offer them every five in SPY. So we're going to go 3. Man, that's going to limit our calendars as well. So we'll go 395 and well, we can do a sandwich. 385. We can do a sandwich and get crazy with this and produce a $3.22 credit. You know what? Let's just go with it. What happens if I get into this trade? I've got a $10 or a 10-cent strike difference with a 322 credit. That means my risk is my max risk is going to be $678. $678 if I were to do something like this. I have calendars at 390. Those calendars are quite a bit away from my 385, which means I'm probably going to be losing money or very quickly losing money at around the 390 area. That's a big credit, so that's not true. So probably be all right in there. But if the market stays the same, moves down, obviously I make $322. If the market moves up to 385, which it's trying to do already, and this is going out 3 weeks basically, you're going to make $322, or you're going to make a little bit more than that actually. So this is a great bearish type trade, and you've got a profit peak at 390, but it's just not far enough away. So I would maybe go, let's see what the 390s with the 395s would do. And this is what I do if I'm looking at a trade and I run into it. I just start asking questions. All right, well, what if I do this? What's the credit? How much better is it? What's the risk? Et cetera, et cetera. Right? And that's the thought process. And then we'll go 400. So 390s, 400, 390, 390. This needs to be 395. All right, so here we have 395s, and actually this needs to be, this actually needs to be, actually this isn't too bad. I'm doing 395s, and then my short is at 395. Right, so that's actually 4 395s and then a 400. That would be a credit of 20. My risk on this trade is $480, and it's not going to happen unless the market's trading at like 405-ish. Right, so this one actually isn't that bad of a trade because you've got calendars at 395. Your short is at 395. That's what you're using to pay for those calendars. That's not bad at all, actually. My original one was be a 390 on the long, and if you're at 390 on the short of the diagonal, if you're at 390 on that, then you're looking at $1.97. So that's $200 as long as the market stays below 390, and it can even go a little bit more. If I wanted to bring this diagonal down, So 390, 395, and then my calendars are at 395. I have an 85-cent credit. My profit peak at 395 is not going to be that big because it's so far away from my short. Right, my calendars are at 395, and that's 5 points away from my shorts. So probably not going to be a huge profit peak. In fact, there's probably going to be a dead zone in that area if I do that. Whereas if I do a 395, there's not going to be any dead zone. If I do a 395, 400, there's no dead zone. I have a 20-cent risk, 20-cent credit. Profit peak is going to be at 395, and it's going to be probably at about 100. I would say about $200 profit peak would be a realistic profit peak at 395. Okay, and that's how you put it together. And if you are not familiar with how these work, when you put these together like this, like on the risk graph, I would absolutely play with the risk graphs on all of them. So let me see if we were filled on this trade. Actually, I lost where it was, so hang on one second. Let's see if we're filled, and then my programmer just contacted me again and asked me if there's any SPY or any data now showing. So let me see here. All right, so any questions? I know the option insanity was kind of a new one, but it's really a simple addition to the two ones that we're already doing. Until I get consistent profits. Okay. Hey, Juan, glad you're here. Appreciate the comment and hope it does work out. I'm going to check something real quick before I get the rest of these questions. Great. Let's see here. All right. I get huge slippage difference with IB. Do you know what it could be? One, when you say slippage, you can't use slippage. You can't get slippage if you use limit orders. So give me an example, because that doesn't sound right at all. If you're using a limit order, how are you getting slippage? Great photo. Thank you. Appreciate it. Okay. So looks like I'm getting some SPY data, which means that so that's progress from earlier. Right. So when putting on crazy calendars or risk-free calendars, do you always put the initial trade in with 2 weeks time value left to take advantage of time decay versus market movement? Patrick, yeah, that's my preference, is to take advantage more of the time decay as opposed to market movement. Obviously, I like putting myself in a position to do both, but I prefer time decay. I had the same issue getting the 1 to 5 order rejected at TOS. Legging in was fine. However, happened twice now, so it must be an exchange issue. Yeah, they were allowing them, and then they stopped. And I don't know. I don't know what the deal was. I mean, they've always said only three lots in one of the legs. That's all we'll allow. And alas, I was still able to put some on, and then it just stopped. How cool would it be if we could just click a button to the spread pattern to import it into portfolio graph? Yep, that's coming, Skip. That is coming. In fact, you won't even have to click a button. It'll just show when you are showing a specific spread. If you go 2 calendars and not 3, you'll bring in more credit. What is the disadvantage? Lewis, the disadvantage, that's a great question. He says if you bring in, if you only do 2 calendars instead of 3, you'll bring in a bigger credit. So for example, we'll drop this to 2 calendars and the credit goes from 20 cents to 43 cents-ish. What's the disadvantage? The disadvantage is that you don't have a profit peak. You have a bump, more or less. Now on this one, it's different because the short strike of the diagonal that you're using to pay for it is actually at the calendar spread. So there's nothing wrong with that. In fact, because you did that, you could probably go up with this, and now your calendars are on the other side of your diagonal spread, which is a great thing. But again, now you only have 17-cent debit or 17-cent credit. So now with only 2 calendars, if you pay 20 cents a piece and you get, then you might, you might get $150 out of this trade max. So you dramatically drop the profit peak or zone. Where do you pull up the risk graph to view? So that's on PDS Trader. And what account size needed for the small risk option insanity trade? Barry, that totally depends on your hedge. Okay, so let me see if I can't put this one together real quick for you. Let's see here. So I'm going to go place trade, and I'm going to go with. We're gonna, you know what we're gonna do? We're gonna do 219 and 222. Why not? And I'll bring this over in just a second. So we're going to buy 380, we're going to buy 390, and then we're going to sell the 385s. Now going further out in time that's the issue with the margin hedge, because you're going to have to go further out with that margin hedge. All right, so 390. All right. So here is 385, 390, 380, 390, 385. Short the 222s, right? And that's showing at a very small credit. So the profit zone here is between 380 and 390. Okay, in the middle of the profit zone is 385. However, to get this, you're going to have to put on 222 longs. All right, so we're going to go and we'll just do that. Let's see how far we have to go here. So I'm going to start with 425 and we'll see if this. So those are going for about 2 or 3 cents, 3 or 4 cents. I'm going to have to do 2 of them. So this right here would cost me almost about $7,000 in margin. That's the issue with going out further out in time. Okay. And by the way, if you can't bring in a credit on some of these and you really need to, and I can't do it with this one, but let's do it this way. I know I'm already over, but we'll get there. 2.5 and 2.8. All right, so with this one, we can it would probably, I mean, you could almost do a 410, right? And that one's going to be less than 5 grand in margin. But look, you're at 37, 36-cent credit. Well, one thing you can do is instead of having a 10-cent, you can put a little bit of risk to the upside, like $100, and move it to 391. And now you've almost got a credit on this one, and you've got a big profit peak, profit bubble there. You would have to go out one more week to get a credit on this one, but that's one thing that you can do. All right. Probably more than what you were asking. Place calendar at a limit of 20, for example, and gets filled at, say, 23. Then you're not placing it properly. One, if you place a calendar at a limit of 20, they're not going to fill you at 23. I have an IB account. I do place these on in that IB account. So you're doing something wrong, and unless I see it, I wouldn't be able to tell you what it is. Can you spend some more time in future session on cash flow trades? Yes, Ken, I most certainly can. Can you add a risk graph on the spreadsheet? Yes, risk graphs will be added to Trade Partner in the future. When you find a copy of Overcoming Self-Destructive Trading Habits. Robert, I did not finish the latest redo of that one, and let me see if I can't find the old one and post it. You're mentioning that Trade Partner works with TradeR and another broker, TD Ameritrade. Works with TD Ameritrade, Mike. What about doing fewer calendars, then putting on more calendars using the risk calendar technique, assuming that you're 2 weeks out? I've done this a few times with good results. Jeffrey, you absolutely can do that. Most certainly. So the question was, what about putting on a couple of calendars to begin with, and then go through the process of putting on risk-free calendars? And he said he's done this successfully a couple of times with good results. So yeah, you absolutely can do that. The one thing is that there are so many different ways, and you guys already see this and you know this, there's so many different ways to do this. You want to be, you want to pick a way, and you want to become really good at that. Okay. And that's how you really master being able to consistently pull in profits. It's not being all over the board. I know that these calls are sometimes feel like they're all over the board. It's because there's so much to show, and there's so many different ways to do it. And you need to focus on one or two of those. I'm not sure whether we will be able to link with TradeStation or not. I don't know that they, I just don't know, Eric. So if that happens, obviously you'll be the first to know if we're able to do that at some point in the future. The Crazy Calendars webinar that I was going to do has been postponed. My schedule just could not fit it in just yet. It most likely will be next week. Got another risk-free calendar on the plunge today. Well, congratulations, Jeffrey. It's good that you have them working, right? Adding the ability to do profit graph and Trade Partner would enhance its utility value immensely. Adding the margin requirement calculation also great enhancement. Yep. That's actually a process of pulling it in from TradeR, and we absolutely will be doing that. So thanks for that suggestion. Okay, you bet. All right, perfect. All right, looks like I got all the questions. And let me check real quick to see if that one trade was filled or not yet. Overview, let's see here. And it was not filled yet. So it's actually now off of where it was. So I guess SPY has come down since I placed that order. All right, looks like I got all the questions, and I will see you guys on Thursday. Everyone have a great afternoon and evening.